Treasury stock, we could have the cost method or the par value method. Under the share retirement, we're going to use what is called the retirement method. Now, if you look up on the screen, here's the key difference between Treasury stock and share retirement. Treasury stock is authorized stock. When you buy it back, it's still issued, although it's no longer outstanding. When you retire the stock, as long as you don't cancel it, if you cancel it, legally, it's out of the authorized as well. So we're assuming we're still going to have these shares. What happens with retired stock is that it is still authorized, but it's no longer considered issued. So retired shares are put into unissued stock. And that is the key. And of course, it's not outstanding. If I cancel the stock, then it's gone. Legally cancel it, it's gone. These are not legally canceled. I can reissue retired shares. I can reissue. So that's the difference. Now, just one other point, and we'll show you this in detail, is that the par value method and the retirement method are equivalent. There's a couple of differences. The primary difference is that the retirement method will reduce the common stock at par directly, and the par value method uses a contra account. And I'm going to leave it here and go back to this, but I just want to leave it on the table so we can see it on the board. Now, in general, when you talk about treasury stock, why do we buy it back? I know you can read this, but let's make sure we understand that treasury stock is a company's own shares they buy back, authorized, issued, but no longer outstanding. You can use it to support the market price of the stock. You can use it to distribute in stock option plans. You can use it in swaps of shares in mergers and acquisitions. You can also prevent takeover attempts. If you buy back enough stock, what happens? You raise the stock price, and the company that's trying to buy your shares now makes the deal more expensive. So it may actually deter a takeover by another company by buying up market shares. Also, you can leave a certain management group in control of the company. Now, you may have heard of these leverage buyouts that were popular maybe about 15 years ago. Managers of a company would have the corporation borrow funds, go out in the market, buy up stock, and leave themselves in control, and then they would form a new company. They would basically liquidate this company and form a new one. So they would basically use debt. That's the leverage. The debt would be used to buy up the stock, and I might hold 40% of the stock. When the smoke clears, you might hold the other 60. Now we own the whole company, and we form a new company. So leverage buyouts can be done that way. And then, of course, this is the one I want you to look at. This is a way to distribute cash to stockholders without raising a dividend. Because don't forget, Apple, I mentioned this, Apple in 2013, at the end of last year, had what was known as a return of capital to shareholders program. it was announced. That program was designed to buy back shares to get cash out to shareholders. That's much safer than raising a dividend, because if you raise a dividend and then try to drop it again, stock price is going to fall. Now, if you use treasury stock to distribute cash, you sell your stock, you've got cash. If you don't sell your stock, what happens? How do you benefit? Market price goes up. The shares you hold are now worth more. So these buyback plans are definitely valuable to shareholders. Now, just to remind you, treasury stock is not an asset, and on the next page, realize that it is not effective stock and it cannot be used to vote, does not get cash dividends. Treasury stock does, in some states, get stock dividends, and all shares in the Treasury will split, and of course authorized, issued, and outstanding will split as well. Now, when you look at, and I'm just going to go through this with you, just basics of the two methods, and the reason why I want to do this is to really set up the accounting. I'm going to tell you that for us, in terms of what I want you to be able to handle, will be the cost method and the retirement method, because as I said, par value and retirement are equivalent. But first, let's understand the theory, and the same theory applies par value or retirement, and IFRS has the same methods. When we use the cost method, the basic issue is how do you value or how do you record the transaction when you buy it? What do you do when you reissue it? When you use the cost method, the shares are bought at cost, they're on your balance sheet at cost, and they are deducted from total stockholders' equity. It is a one-line reduction of total stockholders' equity. So if I can scroll down a little bit and have you look at, it's going to show you Coca-Cola. You don't have to do this now, I'll get to this, but Coca-Cola uses the cost method. Notice that treasury stock is coming off of total stockholders' equity in one line, right? So that's known as the cost method. Yeah. Let me get, sorry. Yeah. Well, when you buy back treasury, when you buy back common, it becomes treasury. Right. And reduce the outstanding shares, right. So,
what we're talking about here is reacquiring back common stock.
And it becomes treasury. Right. No. Right now, we're on the acquisition side. You go in the market, you buy back your own common shares, it becomes treasury. Now, and it's treated as a total reduction of stockholders' equity. Now, when you reissue that stock, it's going to look like an asset. It's going to look like an asset. So let me get to the reissuance side now. When you reissue the stock, it's treated like an asset. If you sell it for more than you paid at cost, it's a gain. If you sell it for less than you paid, it is a loss. Now, the terms gain and loss in here, you got to be real careful because these do not go on the income statement. And I think we mentioned this a little bit in Intermediate 1. The gain and loss on treasury stock transactions are not on the income statement. The reason why they do not go into income and they go into stockholders' equity is because these are considered capital transactions. A capital transaction is a transaction that involves the company's own equity securities. So you have to realize that I don't think you want managers to buy and sell their own stock and put these gains and losses on the income statement. So the gains and losses do not go into income. These are classified as capital transactions. These are items of profit and loss that technically will flow through paid-in capital or retained earnings. They will not go on the income statement because they involve the company's own equity shares. And the treatment of the cost method as a lump sum reduction of total stockholders' equity is under the theory that this is a temporary holding. We're going to distribute those shares again. We're going to use them again. So when you buy it, it's at cost. When you sell it for more than cost, it's a gain. If it's a loss, less than cost, and it goes through stockholders' equity. Now, the way this will work, any gains, we're going to credit. Additional paid-in capital from Treasury stock transactions. You cannot create retained earnings from a capital transaction. Also notice that you have to specify the source of capital. Now, depending on the state, I'm just giving you the textbook, this particular textbook that we use, the KISO book, and I'm being consistent, got to identify the source of capital. Some states tell you to put it into regular paid-in capital. Right? The loss, the first thing you do is you debit additional paid-in capital from Treasury stock. And let me just, second, if APEC from Treasury stock is equal to 0, paid-in capital cannot be negative, then you debit retained earnings. I'll explain. It's like a dividend. So gains go into paid-in capital, losses come out of paid-in capital from Treasury stock if it exists. If it goes to 0, you debit retained earnings. And I'll explain that to you in just a second. All right, so that's the cost method. And we're going to go through a very detailed illustration of that in just a minute. Any questions on that? It's a capital transaction. You cannot have gains going into retained earnings. It doesn't go into income for sure. Yep. Yeah, if that account goes to 0, then you debit retained earnings. Or if you don't have a balance. Yes. Yep. Yep. Let me clean that up. Yes, if APEC from treasury stock transactions is zero or goes to zero, then you have to debit retained earnings. If the paid-in capital account doesn't exist, I just said from APEC from from treasury stock. Additional paid-in capital from treasury stock. Yep.
So if it goes to zero, then you debit the balance so that to get it to zero and then go to
Retained earnings, right? Because paid-in capital cannot be a negative balance. Retained earnings could be a deficit balance. So, and sometimes I know I do. We cover this in the intro class. We cover treasury. I don't know if you did. Doesn't matter. Yeah. Yep. Right. Yep. And if APEC doesn't exist from treasury stock, everything goes to retained earnings. Now, the reason why I'm spending time on this, because we have more than, this is not the only capital transaction we have. As we start moving along, and as I said, the entire purpose of this chapter is really to set us up for the rest of the course. Earnings per share, convertibles, convertible preferreds. We see a lot of usage of this later on. Now, par value. Par value method, just like the retirement method, it's exactly the same as the retirement method in that it is a final accounting with the shareholder. So if you look at the theory, you basically reverse out the original transaction. So if you sold common stock 40 years ago, when you buy it back as retirement or as a par value method treasury stock, you then unravel the original sale. You remove the par value, you remove the paid-in capital from the original sale of stock. At that point, that gain or loss accounted for the same way is recorded, not when you reissue, but when you buy it. If you buy the stock back for more than the original shareholder gave you, it's a loss. If you buy the stock back at an amount that is less than the original shareholder gave you, it is a gain. Everything's done right up front. The good thing is that when you reissue the stock, it's accounting 101. You reissue it like a new issue of stock. So all of the activity takes place when you first buy it. When you reissue it, it's very simply a new issue of common stock. Now, the only difference with retired shares is that you take the par value out of the common stock directly. If you don't have to look at this now, but I'm going to go back to the ACE Limited example. And with ACE Limited, notice what they do. They're using a par value method, and it's exactly the same. And I just want you to be aware, because the par value method is used by about 40% of the companies in the United States. The cost method is used by about 60, it's maybe 60 to 70. So par value accounting is very common. The only difference is that becomes a contra account, and that is a contra to common stock if it's the par value method. So the par value method uses a contra account to common stock, where the retirement method reduces the common stock account directly. And that's the only difference between the two. This is ACE Limited. Let me move that up. Yep. Okay. Sorry. What was that question? Okay. So the par value method uses a contra account against common stock, whereas the retirement method takes it right out of the common stock account. Why? Shares are no longer issued. All right. Now, one more thing to do. First, see if you have any questions, but one more thing to do to be sure that we've got the theory before we start the debits and credits. Question. And that is, I just want I want to be sure, IFRS is the same. Just to be sure, take a look at page 3. And this is the cost method. And basically, when you acquire the stock, you record it at the cost you paid to buy back the shares. Let me just show you why the gain and loss on a capital transaction is not income. It doesn't go into income. Let's take a look at a very hypothetical situation where there's a corporation with one shareholder. So the corporation issues one share of stock. You hold that stock. On day one, you sell it back. So now you take $100 and you give the stock back to the corporation. The very next day you want it back, take the stock back, but you paid $110. So basically what you have is the same share of stock that you held on day 0, but you just paid $10 more. So from the corporation's perspective, what is that? Or from your perspective, what is it? It's paid in capital, right? I mean, basically, this gain is additional paid in capital from treasury stock transactions. Bottom line is that this is very, very simple. If you look at it in terms of one stockholder, you got the same piece of paper you had yesterday, but now you just gave the corporation $10 more. That is contributed capital. That's why it's contributed capital. So the gain is treated as contributed capital. Same ownership, you just gave him $10. Okay? So it's not income to the corporation, it's an additional contribution of capital on your behalf. On the other side of this is if you reissue below cost, let's think of the logic again. Really hypothetical, right? You got one share of stock. You own the stock. On day one, you sell it. The corporation gives you 100. You give them the stock back. Goes into the treasury. The very next day, you want the stock back. The corporation says to you, no problem. I'll sell it back to you for 80. You have the same piece of paper you had, but now you got $20. Distribution to you is like a dividend. Right? So it's either going to be a return of your capital. That loss is either going to be a return of your capital from prior treasury stock. Remember, I know this is like last week, but you got to keep the sources of capital separate. So every source of capital is kept separate. So if there's enough paid in capital from prior treasury stock transactions, the loss first reduces APEC, and if that goes to 0, we debit retained earnings. It's like a dividend. And in fact, the IRS watches this very carefully. Why? Closely held corporation, I could play this game all day long, right? I sell the stock back here, capital gains. You give it back to me, I got a dividend, and I don't pay tax on it. Yeah. It could be viewed as a sham transaction by the IRS, and what they're going to do is reverse it and tax you as if it's a dividend. In some states, they do not allow you to pay dividends if you're holding treasury stock. Why? They're worried that you'll distribute cash to shareholders through these transactions and not have enough to pay dividends, and therefore they restrict the dividend payment. So hopefully that explains why these gains and losses are not considered income, but they are considered capital transactions. They're capital transactions. Okay. All right, now, that's all the theory. As always, going to wrap that up. Any questions on any of the theory? Now we're going to try to circle back, reinforce that with some examples. Any questions on the theory? Okay. All right, now for the example. And by the way, here's Coca-Cola again. And remember, under the cost method, It's a total reduction of stockholders' equity. Also, when you look at this disclosure, notice that up in the common stock, let me just spend a minute here, they give you the par value, number of shares authorized, number of shares issued. Notice the terminology, capital surplus. This question came up earlier in the first section, and remember, capital surplus includes everything, paid-in capital in excess of par. It includes paid-in capital from treasury stock transactions. It rolls up everything on the balance sheet. If you go into the footnotes and you drill down, you'll find the components. For example, General Electric, I don't know if they still use the term, a few years ago, if you went into their contributed capital footnote, it would say gains from treasury stock transactions. They would actually call them gains as well. So they use the term capital surplus. Reinvested earnings are, of course, retained earnings. All right, so here is your illustration. We're going to assume that a company buys back its own shares and will put them in the Treasury in this case. It's not going to be a retirement. They're going to put them in the Treasury. So they're buying back their own shares. They buy back 1,000 shares. It's $5 par. The cost is $50. The original issue is $40 a share. So that means when they first issued the stock, the original issue had APEC of 35. Now, under the cost method, par value doesn't mean anything. Original issue price doesn't mean anything. Under the cost method, the only variable we look at is going to be cost. So, on the date of acquisition, pretty simple. On the date of acquisition, you make the journal entry that is going to debit treasury stock at cost. That's 1,000 shares times 50, and you credit cash. That goes on the balance sheet, as you saw in the Coca-Cola case, as a total or reduction from total stockholders' equity. Let's take the T account here. Treasury stock is debited for $50,000. A few months later, company decides to sell the stock. It's going to sell 450 shares at a price of 70. So the selling price, 450 times the 70. So they're going to sell the stock at a total of $31.5. The cost of 450 times the 50 is $22.5. And there is a gain, which is additional paid-in capital from treasury stock of $9,000. So when we make that journal entry, if you go to the next page, on the disposal of the treasury shares, we're going to debit cash for $31.5. You're going to have treasury stock credited at its cost, and the gain, again, does not go into income. That's additional paid-in capital. So at this point, after that entry is made, we have, this was a reduction of $22.5. So now the balance here at this point is $27.5. and you have 9,000 in paid-in capital. The gain cannot go into retained earnings. That's the key. You can't create retained earnings in this case. Okay. Any questions on the acquisition or the disposal of a treasury stock using the cost method? Yeah, Sal? Yeah, what will happen is under the cost method, let me just make sure, I'll put this back up for you in a second, but let me put the Coca-Cola up first because this is the, where can I find it? Oh, come on, man. Oh, wrong, that would help. Okay. All right, here we go. All right, so for Coca-Cola, let's leave this right here and make it smaller so you can see it. So let's take your question again. So you're saying in the stockholders' equity section, on the day we buy it or the day we dispose or both, or? No. Yeah, so that's, okay. So this would not change. So here it still says number of shares authorized, 5.6 million, issued 3,520,000, and down here the Treasury is 1217. So to find out the outstanding, you would subtract the shares in the Treasury from the shares issued up in the balance sheet. So nothing changes in the common stock disclosures. Okay. Okay, any other questions? Let me move this where it belongs. Okay. Anything else? Okay. Let's take a look at selling the Treasury at a loss. Now I'm going to say that, well, I've got the remaining 550 and I want to sell them. I'm going to sell them now for $30 a share. So what happens is now and it's 550. So we have 550 on the number of shares for the $30. So that's 16.5. The cost is 27.5. It's 550 shares times 50, or of course the balance that's here. So there's your balance. So 27.5. And in this case, there is a loss. And that loss is 11,000. Now the question, of course, is what do we do with that loss? In this case, the loss is first, if we go back to the theory, it's first a return of capital from treasury stock transactions. When that goes to zero, the difference is then coming out of retained earnings. So in this case, I'm going to be able to allocate this. So that loss is first going to reduce APEC from treasury stock by 9,000. And then I'm going to reduce retained earnings by 2. So in this case, if I bring up that entry a little bit on disposal, cash comes in, by the way, all treasury stock transactions are what kind of activities on the cash flow statement? Operating, investing, or financing? Financing. Treasury stock is a financing transaction. So all of the cash flows related here are financing transactions. We've got a debit to cash for the amount of 16.5. The loss is 11. First, the loss is debited to reduce paid in capital. When that goes to zero, that's it. You cannot have a negative balance in capital or contributed capital. And then the other part of the loss is debited to retained earnings, and you credit treasury stock to zero, closing out that account. Now, in the event that there was no paid-in capital from previous treasury stock transactions, what would you do? What if this account was zero? You debit retained earnings for what? $11,000. Now, I know everybody's getting itchy for the exam, so on the exam, if you get this question and you debit paid-in capital from treasury stock, you've got to have a good reason for it. It's got to be there. I've got to tell you there's a balance. Or the balance has to be created from a prior transaction. So make sure, and again, just to be clear, and this is not my rules, but just to be clear, some states allow you to take the losses out of regular paid-in capital. And I give you those options in my notes. So I would tell you, some states say, take it out of regular paid-in capital from regular share issuances. When that goes to zero, take it out of paid-in capital from Treasury. And then when that goes to zero, take it out of retained earnings. But we have to have some order of semblance. We have to be able to come up with some procedure. And the procedure used in the KESO book and my notes is that, look, Treasury stock, APEC is the only place you could take the loss. If that goes to zero, retained earnings. Yep. No, I don't know. The laws are all over. It's like Wild West, Every state has different laws. Probably, if you look at Delaware, they have the most liberal incorporation laws. In fact, in Delaware, you could pay a dividend as long as the dividend doesn't exceed the market capitalization of your stock. So that means you could debit retained earnings to the point where you have a huge deficit. So it just depends on the state. I'm not sure about New Jersey, New York, but the textbooks, CPA exam, have this generic where you have to follow this order. Okay. Any other questions? Okay. Now, for share retirements, what I'm going to do is give you a side-by-side illustration. And now, when you have the share retirement, that's when the par value and the original issue price makes a big difference. And I'm going to tell you that in practice, you're probably not going to know the original issue price. I guess if you have sophisticated computer records, you can figure it out. Get the certificate numbers and determine it. What a lot of people do is take average APEC. In other words, they'll take the number of shares issued and divide it into total contributed capital in excess of par to get that number, get an average. But let's see how this would work. When you deal with the retirement method, and the par value method is the same, except they use a contra account instead of debiting common stock directly. In this case, if I buy back $50,000 worth of treasury stock, I have to compare that to what I received on the original issue. So in this case, the whole game changes because we are worried in terms of or concerned with how much we received on the original issue. So now we take the acquisition cost. It's a totally different perspective. That's an outflow. You just paid $50,000 to get back 1,000 shares. At some point in time, the original stockholder gave you 40. There's a loss. So under the retirement method, there's a final accounting with the stockholder. Final accounting with the stockholder. So that you paid 50, someone, whenever they bought the stock, only gave you 40, so that there's a loss. Now, in this case, notice what happens. You have to remove the original common stock you issued, and you have to remove the original APEC that was generated on that sale. So that this is considered, if you look at the green highlighted area, this is considered a final accounting with the original stockholder. These shares are now retired. They're not canceled. So they are still authorized. They're now considered unissued and can be reissued again. So that the par value is removed, 1,000 shares of $5 par. The APEC on the original sale was 35. 1,000 times the 35. These are debited and they go. Why does the loss go into retained earnings? I'm just going to show you with a T account. There's no balance here. You have no paid-in capital. There is no paid-in capital from share retirements. Therefore, the loss has to go to retained earnings. It's a return of capital. Not only did I return all of your capital, but I also gave you a $10,000 dividend, right? So when I give you $50,000, again, assume it's one shareholder, when I give you $50,000 to get back the stock that you bought at 40, obviously no time value of money. We're not getting involved with inflation, but you gave me 40, I'm giving you 50. So I'm giving you 40,000 of your own capital back, and then I'm giving you the 10,000 bonus or dividend in this case. And that is the retirement method. It's a final accounting for the stockholders. Just make a note, you're not going to be asked to do the par value method, but on the par value method, instead of debiting common stock at par, you debit common stock in the Treasury. As you see in the ACE Limited case that we looked at, it's a contra account here. So instead of debiting common stock directly, you debit a contra called common shares in the Treasury. That's for par value. Any questions on this? Because by the way, the rest of this is real straightforward now. Now, what makes this very straightforward is the following. When you issue stock that has been retired, when you reissue it, because remember, it's no longer issued. When you reissue it, it's a regular sale of stock. So if I sell the common stock at $70 per share, I'm going to debit. Let's go up to the first retirement entry or the first retirement method entry to reissue. I'm going to debit the cash account for, in this case, it's 450 shares times $70, which is $31.5. I credit 450 times 5 at par, and the difference goes into paid-in capital. All right, together $65 times the 450. Then when I reissue the remaining shares, I have, in this case, 550 shares times $30, or $16.5. Debit cash, credit again from financing activities, credit common stock at par, $27.50, and the excess goes into paid-in capital. Now, these last two entries, and this should actually not be, this should be the retirement method here, not treasury stock, so it's the retirement method. The last two entries here are, in fact, accounting 101, right? Just issuing common stock, or what we did last week when we first started this series of modules on stockholders' equity. So, any questions on the last two entries? Once again, something you should be able to do. Just forget about the fact that this was in the Treasury, and just remember that you treat them like new issue of common stock. And the reason for it, again, is that under the retirement method, those shares are no longer issued, so you have to reissue them again, and you treat them like newly issued stock. Okay, so now, before we get into our last two topics, any other questions on treasury stock, anything else on stock dividends? Now, make sure, and I'm going to email everybody today with exam topics and the homework and all this, but just make sure, hopefully you were starting to do the assignments already. Get a good jump on that. And I'll outline the exam for you as well. And maybe if you have a chance before we leave, I'll do that. Do the same. Okay, so anything on this at all? Last two topics, very simple. By the way, we used to, I think I might have mentioned this, we had videos, I shot some videos. I was flipping part of the classroom last year, but nobody liked it based on a survey. So I have videos on leases, real estate leases. I have a video on stock subscriptions. I have a video on prior period adjustments and also other comprehensive income. So if you want, you could also view those. Those are up on Blackboard as well. And these classes are being posted on, I think some of them are on YouTube already. I'll get that information to you as well. All right. Let's take a look at these last two topics. They're very short, but they are very useful as well because they are pretty common in practice, obviously. The first one is something known as prior period adjustments. And if you look at the yellow highlighted area, you notice I'm telling you that this is a part of what we call the all-inclusive concept of income. If you go way back, it might have even been in August or September when we started the fall semester, we said that two concepts of income, all-inclusive and current operating performance. Current operating performance says, all I want on the income statement is operating income, extraordinary items, discontinued operations, all of that should go into stockholders' equity. All-inclusive says everything should go on the income statement. Today we have a modified all-inclusive. The income statement includes most items of profit and loss except for prior period adjustments and other comprehensive income. So these are the exceptions to the all-inclusive concept of income. Now, what is a prior period adjustment? There are a couple of types. One you may see in advanced accounting, which deals with realization of tax benefits from a purchased subsidiary, and that deals with mergers and acquisitions. For us, our universe of prior period adjustments will be corrections of errors made in previously issued financial statements. If there was a mistake and you didn't have a chance to correct it and reissue the financials, if you made an error, and that error could be a mathematical error, that error could be a misapplication of generally accepted accounting principles. If there is a mistake or an error in any previously issued financial statements, that error has to be corrected when it's discovered, and it is done through the balance sheet. It is an adjustment to opening retained earnings net of tax. If prior periods, if you have 3 years, 2-year balance sheets presented, you would show it retrospectively. Now, I'll give you an example, assuming that prior years are not presented. And for tax purposes, really, this should go something like 2006, let's say, okay? Or 8, let's make it 7. I'm not getting my numbers, I don't know why, but anyway. Probably it's not on here. Okay, so let's make it 2007. So let's say that in 2007, there was a sale for $4,000 that you did not record. You didn't collect it, and you didn't pay tax on it. You discover the error in 2012, and the tax rate, we'll assume, is 40%. This is going to be considered a prior period adjustment, and here's the way it would show up. Everything else in the stockholders' equity section is assumed, so the common stock or capital stock, paid in capital in excess of par, that's all presumed. The prior period adjustment must be reflected as an adjustment to opening retained earnings net of tax. So if you notice, the calculation tells you that if the tax rate is 40%, the error in income was $4,000, so the after-tax benefit would have been 2.4 had you reported it. The $2,400 would have been recorded. It would have flowed through stockholders' equity, through retained earnings, and the retained earnings would have been 16.4. Now, obviously, you may have to file amended tax returns. You may have to contact the customer and try to get paid and all of this. Whether there's penalties and interest remains to be seen. But the journal entry you would make for the prior period adjustment would put the receivable on the balance sheet, would credit the adjustment to stockholders' equity, and credit the tax payable. Now, this is the result it's the same result if you would have avoided the error in the first place. Somebody help me. What would you have done if, let's put it right here, if the error was not made? All right, so help me with the entries. You got a sale of $4,000. What do you do there? Right, sales. Yeah, let's say it's sales. Okay. Then you have to record tax expense at 40%. What would you do? What do you debit? Tax expense, right? Tax payable, right. Okay. All right, so that's how you would record that transaction. Closing entries. How would you close out the accounts? How do you close out revenue? What do? Debit revenue, credit income summary. How do you close out expenses? Debit income summary, credit expenses. I'll put this in one entry. So you'll have sales. You'll have tax expense. And you'll have income summary. Then close income summary to what? Retained earnings, right? All right. So, what accounts are still alive and kicking after that closing process? Well, if you notice, sales goes away, right? So sales is gone, tax expense is gone, so is the income summary. So all that's left is the debit to sales, the credit to tax payable, and the credit to retained earnings. So all you do with the correcting entry is to recreate what would have been done in 2007 had you not made the error. And the same effects get reflected into the financial statements. Exactly the same. Exactly the same. So that entry, and by the way, in the CPA exam, although we don't cover that, the chapter on accounting changes and error correction. We did accounting changes to a great extent in Intermediate 1. This is sort of like similar, although they do it to much greater extent, error corrections on the CPA. Yep. Yeah, it could, because now you may have to, there's a lot of other things that could happen. Good point. So now what could happen is that I may need to put an allowance on my books if I don't think the customer is going to pay that amount. It could also affect the tax penalties that I'd have to pay, interest to the government for unpaid taxes. I'd have to file amended returns up to like 5 years. That's why I went back 5 years. And the other issue is, what else could happen here? Oh, and I might charge interest to the customer as well. If I felt that they might have known, I mean, obviously they got the product, they fell through the cracks on there and they never told me, so I may chase them for interest as well. So yeah, a lot of other accounts could be affected. Okay, now last thing we're going to do, and I know I said I'll keep an extra couple of minutes and it probably won't be that long. And if you want, I will talk to you a little bit about the exam. I want to make sure we understand what we mean when we talk about comprehensive income. Now, comprehensive income, the way I look at it, and the way I think the easiest way to look at it is to think of comprehensive income as a change in equity, a change in wealth from all sources except your own contributions and withdrawals from a company. So if you had your own business, you would look at wealth in a lot of ways. You would look at it as sales. You would look at it in terms of increases in the value of a portfolio of securities that you're holding. You would not consider income any dollars you took from your personal account and put it into the business, because that is your own contribution. And you wouldn't consider earnings anything you took out of the company, because that's a withdrawal. So it's the same concept on a corporate level, so that it's all changes in equity, all changes in wealth, except for transactions with owners. Net income, which we know what that is, and other comprehensive income. Now basically what happens here is that net income gets closed to retained earnings, and other comprehensive income gets closed to accumulated other comprehensive income. Okay. So it is part of income as well as net income. Other comprehensive income is just like, or considered income. Okay. Now, we know what net income represents. It's revenues minus expenses. Let's just review what goes into, or what are the components of comprehensive income. Right now, and these are shown net of tax, the tax could be on each item individually, or it could be in total. Unrealized gains from marking securities to market. We'll talk about, I'll see if I have a chance to do any hedging or derivatives in this class. If not, it should be picked up in advanced accounting over the summer. Foreign currency translation gains and losses, that's definitely covered in advanced accounting. And we're going to cover pension gains and losses here as well. Now, again, we keep these off of the income statement because of these reasons: low probability of cash flow realization in the short run, the volatility in these items, and the fact that it's not part of normal operations. To give you an example, I mean, if you just look at the pension plan adjustments, just take any large corporate pension plan. Every day there are changes in assumptions, life expectancies, turnover rates, costs of providing pensions. On top of that, we also include health care. Anytime there's a change in the cost of health care, all of those future benefits have to be considered. So that the gains and losses will fluctuate significantly, but they will not be realized now. I have to wait until you retire. So most of those gains and losses aren't going to happen in the short run. The same thing with the unrealized gains and losses on securities. If I'm holding a portfolio that I don't trade on a regular basis, I'm not going to realize those gains and losses until I what? Sell them. So I'm holding stock today, check the stock market, it goes down, yeah, my wealth dropped, but it's not considered as net income, but it's part of my wealth change, and therefore it's part of my comprehensive income. Now, in the event that the probability is high, it does go into income. So take a financial service company like Prudential up the street. They hold portfolios that they trade every day. If they're holding a portfolio of trading securities and those securities tank, that loss goes into net income because there's a high probability of cash realization. Now, the key for us is, all right, fine, we know what gets there. How is comprehensive income going to be reported? I want you to be careful because a lot of people buy used textbooks. This has changed. You have to show comprehensive income in a statement, either appended to the income statement, that's the single statement method, or as a separate statement with the income statement. In other words, two separate statements. And I'm going to show you an example of a two-statement approach. You also included in the statement of changes in stockholders' equity that I showed you earlier. Now remember, the reason why we're doing this is that companies historically try to bury comprehensive income in the stockholders' equity statement. Now it must be a prominent part of your income reporting. Earnings per share is not going to be included. So here's an example of the two-statement approach. That net income of $542,982 came from your income statement. So just imagine there's an income statement that has a bottom line of $542,982. Then you got your comprehensive income. And you got currency adjustments, you've got adjustments on securities, on investments. And let me just, again, I need to point this out to you, that just take a look at the volatility that these adjustment items occur. Translation adjustments that relate to foreign subsidiaries that you're not going to sell. Loss in 2012 of 1843, gain of 18,008 in 2013, and a loss of 7448 in 2014. I mean, these numbers are all over the place, and these are the numbers you want to keep off of your income statement if they're not going to be related to cash flow. And of course, the 542,982 of net income gets close to retained earnings. Other comprehensive income of 135,606 goes to accumulated other comprehensive income on the balance sheet. So this will eventually be added to that amount. So you have to show comprehensive income either attached to the income statement or as a separate statement. And you also show it in, if you remember, looking at ACE Limited, you also show it in this statement of shareholders' equity. And you could show it here as well. It's a separate statement, but it is not the only place you could show it. You're not permitted to only put it in the stockholders' equity statement and not show it